This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report. Each week I go through a ton of reading and research, charts, and what I do is on Saturday mornings I send out a free email report where I just pick out just a handful of these things, the few things that I found most valuable during my week's worth of reading and research. That can be maybe a link, a chart. Usually it's just 4 or 5 things. If this is something that you'd be interested in receiving, just go to thefelderreport.com. Right there on the homepage, you can sign up and be good to go. My guest for this episode is Jerry Parker, and Jerry was one of the original turtle traders. This was an elite group selected by legendary trader Richard Dennis to learn his trend-following strategies and actually take over a couple $1 million of his money and manage it using these strategies for him. So Jerry learned trend following from the best in the business and has been practicing it on his own now for 30 years. Jerry is a brilliant guy, and in this conversation we get into what he believes made him stand out among over 1,000 candidates, what it was about trend following that really appealed to him, and what it is about trend following that should appeal to individual investors. Jerry even gets into how individual investors should think about implementing trend following in their own portfolios. It was a real treat for me to be able to pick his brain for about an hour, and I hope you enjoy our conversation as much as I did.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered.
Jerry Parker, welcome to the show. It's really an honor for me to have you here, and thanks for doing this.
Oh, Jesse, thanks for having me. I'm looking forward to it.
Yeah, it's you've been somebody that since I started this podcast, I thought, I've had your name on my list. I definitely want to get Jerry on the podcast because you are an investor unlike anyone else that I've talked to so far since I started this show. But before we get into that, I read somewhere where you said Richard Dennis rescued you from a normal life. And before we get into, your investment process and all that kind of stuff, who was Jerry Parker before you ran into Richard Dennis?
I'm prone to use extreme words like that. So, but it was sort of a rescue from a typical life in a small town, being a CPA and graduating from college with an accounting degree and doing audits and tax work. And I knew pretty quickly that that's not what I wanted to do long term. I wanted to do something more fun and creative, and the markets. I was intrigued by the markets, loved the markets. Watched Wall Street Week, Marty Zweig, read books and newsletters, and immersed myself into that field. And fortunately, when I was practicing accounting for just 2 or 3 years out of college before I left, I had some free time, and I used it to try to figure out my worldview and philosophy and what works and what would be good doing in that particular field.
And so, if it wasn't, something you studied in college, you said you got an accounting degree. What was it that first got you interested in finance? Because it sounds like you had a passion for it before you even ran into Richard Dennis.
Probably the old cliche of competition and getting a daily report every day on how you're doing and putting together a plan and a game, sort of a games mentality of approaching things. I don't know. I definitely first heard of technical trading and trend and price, looking at prices and charts and moving averages. And I was like, that is me. And I never spent 1 second thinking that, value. And even though ironically, I was looking at balance sheets and income statements as an accountant, I was not interested in that at all and thought, the lack of subjectivity. I thought that was really good. These are objective rules that we're going to be using. We can test them. We can look at them. And so I thought that really suited my character. Yeah.
Well, it seems like that's something critical to discover. It's one thing I hear from a lot of people trying to copy other people's investment, styles and things. And I think you make a great point in that it's really critical to find something that suits you and that really speaks to you and some part of your personality and your values. But it's also really interesting to me that you had a background in, financial statement analysis, and value investing didn't appeal to you. What about it to you seemed like, that just doesn't fit me?
I remember looking at charts early on and looking at trends. And of course, looking at a chart trend or flipping through charts and seeing trend after trend doesn't really tell you one thing. Your brain will see more patterns than really exist. And the computer, as it goes back and does a back test and looks at rules, applies these rules to actual price data, is very brutal. And it comes back with an answer that's not quite what you were hoping for most of the time. So, but I think just that allure, I can't really remember, but I remember getting an interview at work for Richard Dennis where I got my big break, and I had studied trend and charts and thought that was just the greatest thing. And I also thought, well, this is going to be a great opportunity. I hope it's trend following. Yeah. So I wouldn't leave out the possibility of going to Omaha and answering an ad and hoping it was trend following, but it did not turn out to be that, and had been Warren Buffett or someone equally as talented or talented as in value investing. And I would have possibly changed right then and there and said, oh my gosh, what a genius person. What an amazing opportunity. I'm not going to blow this. So it was kind of interesting and lucky that it all worked out the way I was hoping it would.
Well, that's right. Let's take a step back. And so you were actually looking for a career change. Is that how you came across you saw Richard Dennis put an ad in the Wall Street Journal for a trader training program. Is that right?
That's right. Wall Street Journal, New York Times. We're going to hire 15 people, teach them how to trade, and we're going to give them $1 million of our own money after the training period and see what happens, sink or swim. And I thought this was really a great idea. I was definitely looking to move on and had been rejected from a more traditional broker jobs or trading assistant type jobs in my hometown of Richmond, Virginia. And so then I was very disappointed that I didn't get those jobs. And then all of a sudden, the fall of '83, I got the greatest job in the world. Didn't really deserve it necessarily. No one should expect such a thing to happen, even if you're prepared to maximize an opportunity. It's that's all you can do. Be prepared to maximize your opportunity if it happens, but it's unlikely that's going to happen. One of the chapters in Taleb's book, I believe Black Swan, is one of the paragraphs, and it is put yourself in a likely situation to have someone change your world. Go to cocktail parties in New York City and talk to people. And, what great advice, read the want ads of the Wall Street Journal. Who even reads those want ads? Well, I happened to that particular day, thankfully.
Yeah. And what do you think, for the first thing I think of is, thank goodness that you didn't get accepted in any of those earlier jobs. It's funny how things work out that way sometimes. But what do you think it was? First of all, how many people applied for these spots?
According to the Richard Dennis, it was 1,000 people each in 1983, and they did it again in 1984. So I was a part of the 1983 group of 12 people, and then in 1984 they hired 8 people, and they probably interviewed 50 each year. So I was one of 50 who got an interview. And went to Chicago with lots of notes and ideas crammed into my head, which, of course, I forgot all of that when I went in for my short interview.
Well, and so do you have any idea of how what do you think made you stand out?
Well, that's a good question. Oh, two things. When we sent the resumes in, they sent out a true-false test. So it was 100 true-false questions. And I think they wanted to hire people who did well on this test, and people who did poorly, they didn't really care. They just wanted to see hire different types of people. And the test was a little bit about trading, but trading philosophy, psychology. How do you think about life? One of the questions was true or false. It takes money to make money. True or false, a trader should love their losses. And so they were looking for people who maybe were different. And so I did really well on the test. They told me that I had the highest score out of 1,000 people. And it was just because I was really into that. I had studied. Reading Marty Zweig books gave me my first idea about trend following, and seeing Marty Zweig on Wall Street Week. So once again, I thought this was the greatest thing ever, trend following. I thought it was fantastic. So I was bought it hook, line, and sinker. And it took me, 15 minutes to really like it and understand the basics. And then when I had the interview, I don't know, I was probably full of myself. One of the questions they ask everyone is, on a scale from 0 to 100%, how much do you think you already know about trading? And I said, well, probably 90%, right? Which is sort of laughable and dumb. And I think one person did more, like 99%. And Liz Cheval, the only woman they hired, she said, close to 0. So, that's kind of an interesting little study there on the male-female way of answering questions and being humble, which the guys have a tendency to fail. But I think I said something to Rich like, whether you hire me or not, I will become a trader, So what does that mean? More bragging and overly aggressiveness, but I think he was kind of impressed by that. And I've thought about that statement, which sort of begs the question, what kind of trader would you have been? Which really could be a sad story, because the type of knowledge that we were given and the tutoring and the environment that we were put in was just unparalleled. And reading books or being told rules or figuring out rules on your own is really not the same as experiencing those 4 years with those genius people and having capital allocated to me. And if we lost money, we were following the rules. If we were following the rules, there was no problem. And that's sort of a pretend environment when you get out into the real world with clients who don't really care, bottom line, if you're following your rules or not, as long as you make me money. So the first 4 years really laid the groundwork for all of us to have a different experience that was going to be very beneficial for the future. When the going gets tough, you can always think back on that mentoring and the support that we got. We literally lost a ton of money in the first 6 months, and their response was to give us more. You're following the rules. You're doing what we told you to do. Full speed ahead. Here's more money. And of course, then that rest of 1984 was very, very positive returns.
Yeah. Well, let's back up a second. I mean, this sounds like, an amazing program, and I haven't heard of anything, even similar. But so Richard Dennis was very successful, commodity trader, Chicago. And was he looking to replace himself? Well, I mean, what was the I guess the intended outcome here before you even started trading and stuff? What was he looking for?
That's a good question. That question and others, like why did they do this program? People have debated back and forth. I'm pretty sure it had nothing to do with a bet or trading places, or a bet saying one person says, I think we can teach trading. The other person says, I'm not so sure. I doubt if it had much to do with it. they had good resumes, they had smart people, and we had to follow the rules. And so following these type of rules, it didn't, the level of intelligence wasn't critical, although they had tilted it a little bit in their favor to have people who, had some intelligence and more than average, let's say. But I think there was a couple of things that I heard firsthand, which are not that controversial. One would be to add value. We're going to give you these rules, and we're going to lay them out philosophically, a 2-week course, and then specifically rules 1 through 10 to buy and sell, to enter into exit, and portfolio management, and taking losses, small losses, and letting profits run, and things like that. But it was very intense and very in-depth. And it was a lot about here's how you can evolve over the future. And it's not just here are the rules today, but you want to stay in business for 30, 40, 50 years. So things will change. But what we want you to do is give us some good feedback, some flair. Flair was a word that they used. Please give us any ideas, and we'll research those, backtest those. You're using our systems and our ideas. Maybe you could give us some of yours. And that didn't really pan out as well as I think they had hoped it would. The way it was set up, we were all in one room, and so we were all listening to each other, who was doing what, and that sort of made us all want to do something similar. And we felt like that there was too much risk probably in deviating too much from the rules. The downside was too great, and maybe the benefit, we'd still accrue the same benefit by doing what Rich wanted us to do and being loyal to him and not trying to be too crazy. So I don't think we added much flair and much discretion, positive discretion. And then I think we felt very beholden to trading the way we were taught and not blowing up what a great opportunity. And probably Rich felt like that he could be less wedded to his own systems if he felt like it. So maybe having the Turtles trade a sum of money strictly by the book would be a compliment to he and others in the firm maybe not having to do such a thing or not even desiring to do such a thing. So I think it would be nice to have a certain sum of money that's strictly by the book.
Gotcha. And the name, the Turtles, was that something they called you? Where'd that name come from?
Well, early on, you're 12 people in a room, and you're trying to come up with a nickname for yourself. You're feeling pretty good about yourself. This elite group that sometimes didn't look that elite. So we came up with a lot of names, the 12 disciples, the apostles, and then evidently nothing stuck. So evidently Rich was traveling, and wherever he was, he saw a turtle farm where they farmed turtles or raised turtles. And one of his buddies said, "Hey, that's kind of like you raising traders back in Chicago." And so that's kind of the Turtles. All of a sudden, one day, we were placing orders over the telephone to the floor. And one day somebody must have said, "Hey, you guys are called Turtles now." And we're like, "Okay, fine."
It's not quite as cool as the apostles or anything, but it does make sense. And so you said the strategies that he had or the rules that he gave you guys were pretty complicated, but was this your first experience with like trading on a trend following program?
It was definitely my first experience trading, but not thinking about trend. I read some books as well, and I was pretty open-minded as a young person. And I remember before I got the job reading a book about futures, and I was like, I don't really understand what this is about, but futures, this opens up an avenue to currencies and commodities. That's got to be pretty pretty decent. I mean, it's more diversification. I instinctively thought that's got to be good. Diversification is probably a good idea. Shorts as well. Oh, definitely shorts. I could definitely see how profiting from things that go down in price from a pure profit point of view would be desirable, and probably pretty good idea for diversification as well. So I talked to so many people over the years and try to convince people to invest, with our firm, and here's what we do and here's how we do it, that usually you walk away and you're just like not going to get money from these people, and you are usually going to sort of say to yourself, I just don't understand why I can't explain this better. Why can't they just understand what we're doing? It seems so obvious to me. And I think it is to some people. They sort of get it and like it initially, just like me. And I thought this was the greatest thing ever. No one has told me really anything unique about it or give me any tremendous insights about it. But I think this has got to be fantastic. And then to go up there and get a job and work for these guys who were just geniuses and had really put the work in, developed the algorithms, did the math and did the computer piece, and then also had extensive experience actually trading on the floor, putting all three of those pieces together, the math, the back test, the computer, and what's reality when you go and try to execute trades in the futures markets. I think that's a big edge that they had versus purely academic, that person who had never been involved with markets at all.
Right. And so, well, let's try. And you said you sometimes have a hard time explaining or convincing people of the power of trend following. How do you explain trend following to just the average investor?
Well, I think less is more. I think if you don't want to understand it, you won't like it. You won't understand it. And so I think it's a few things going forward. It's we're taking small losses, and I think that's probably a really good idea to limit your losses. Proper money management. You've heard a million hedge fund people talk about that. Certainly, diversification is a key. Currencies, commodities, stocks, bonds, long, shorts. We can put together a portfolio that's very diverse. And then momentum. Does momentum work? Can you just purely look at price data and create a pretty simple? I didn't say simple earlier. I said intense. So, but I guess to some degree, the entries and exits are sort of moving averages or breakouts. But is this momentum? Has it worked? Is it going to work in the future? Are you okay with 40% winning trades? Or, that's, kind of a bummer, kind of a downer that most of the trades are losers. A very small percentage, 5 to 10%, would make all of your profit. It's kind of a tough equation to enjoy on a daily, weekly, monthly basis. But it does make a little bit of sense that you would think that successful investing would be hard and difficult and not cater to our desire as humans to make 1% a month. And certainly you've got to have more than 50% winning trades to be profitable. That makes no sense that you would sit back and take all these losses and all this pain and drawdowns and lack of positive reinforcement to wait for 5 or 10% of the profits 5 to 10% of the trades to make all your profit. So, in a nutshell, I just remember sitting there in my office in Richmond, Virginia, going, here's the answer right here and now. Do the big winners pay for those losers? That's it right there. And so you do the research, you do the back test, you live through it. And yeah, it seems that for the past 30, 40 years, for me anyways, my big winning trades paid for my losing trades. Nowadays, I'm tempted for the first time, maybe, in a long, ever pretty much over the past 5 or 6 years, to sort of ask another similar question, a bottom line sort of rude question, which is, are stocks superior? It certainly looks like it. I didn't think that. I'd never seen that before, but we've had just an extended period for trend following CTAs and managed futures to really have to wonder how much longer do we get punished for our tremendous amount of diversification, because it does seem like stocks are pretty darn special and have these great trends and keep going up and up and up and defy logic and wisdom and valuations, and which is what you'd expect from just following trends. The CTAs look really smart when it looks like when people can't really understand why the markets are doing what they're doing. The CTAs blindly follow these trends. We would have been the only ones to be long the tech stocks in the late 90s, short oil at 90, and rode it all the way down to 20, staying long the bonds as they approach 0% rates. So that's what we're known for. What we're good at is when odd, crazy things start to happen, we just follow trends.
And when you were talking about your big winners, really what you're trying to accomplish there is using technical indicators to help you capture the meat of a big move in one direction or the other, to upside or the downside. I mean, that's how I think of trend following. Is that am I close there?
Well, that's exactly right. And not another good thing about it is it doesn't make sense from a mathematical point of view or from a performance point of view, theoretically or actually, to limit or to have a cap on what you think the market's going to do. So just if the market breaks below your moving average exit, then you get out. But do your best to ignore the fundamentals, or even more so the headlines that purport to be fundamentally driven. Try to not pay attention to those. And if you get nervous, hang in there and don't exit prematurely. In fact, part of our training, which I think has sort of been lost over the years for most CTAs, was a heavy dose of contrary opinion. And one of the ways that we used to utilize what we called contrary opinion would be something like if you were in a situation where the market, the mood of the market, let's say the stock market, was particularly bullish, like now, and the market was bullish, and the trend was strong, uptrend, like now, and then if you get into a taxi and people say, how about those stocks? Then you're like, oh my gosh. And the lowest form of the headline, so the New York Times would not be as good as like your local paper. Even that local paper was talking about stocks and how wonderful they were. And then if you had a report come out, GDP or employment or something that should send the stock market higher, and the market started going lower, that would be a good time to sort of maybe exercise some discretion, part a little bit from your strict rules, and have some fun by when the fundamentals and the sort of technicals disagree, then you want to kind of do whatever the market is doing. So we never wanted the fundamentals and the technicals to agree. We always wanted them to disagree, and we would feel more confident to follow the trend.
Yeah, I mean, it's kind of like that old Wall Street adage of, the market climbs a wall of worry. You don't want everything to agree, because then it's tough to, Howard Marks says you have to have a non-consensus view to make money in the markets. If you agree with what the market says, it's already priced in, and there's little opportunity to make money. But you mentioned it seems like stocks are, tell me again, what were you saying about stocks there? Because I think you said something like, about stocks being better for trend following, or were you saying just kind of a buy and hold approach is better than trend following?
Well, it just seems that since recently, the Great Depression, Great Recession, zero interest rate policy, that it does seem that stocks have had better trends than commodities, for instance, or the currency markets. And so we live and die by these trends. And if we don't get them, especially long trends, the shorts are pretty good. They will add some diversification, but the big money is going to be made on the long side. And so one of the cornerstones of what we do is there's no opportunity lost by trading things other than stocks. They all have the same expectation. They should all make about the same amount of money, over a long period of time. And you just throw in this diversification into your portfolio, longs and shorts, with no opportunity cost whatsoever. And yet it's difficult now to sort of continue to tell clients that when they see the stocks outperforming,
Well, that's a difficult thing for all of us who are not just passive buy and hold aficionados, right? I mean, any other strategy besides just a passive buy and hold approach looks, stupid in retrospect. But that, at the end of any 10-year, bull run like we've seen, that's going to be the case. So if you had any type of strategy, any type of hedging or anything, or more of a value discipline, you have looked, foolish over the, in relation to that passive buy and hold approach. You keep mentioning diversification, and you've actually tweeted about it a few times recently. What are your thoughts on here? How do you think about diversification in terms of trend following? Is it just making sure that you use more asset classes and more the more the better? Is that kind of what you're thinking?
Definitely more unique asset classes. The better. Once again, it's back to what I was saying earlier. The approach desperately needs lots of diversification. It's the winning trades. We have 60% losing trades. We're taking these small losses all the time. We're waiting for outliers, which kind of can come and quickly, and then we won't see them for a while. So the fewer markets and the fewer the less unique group of markets that we trade, we can really have some poor performance. But if we're spreading that risk and this particular methodology that has those characteristics across lots of different markets, lots of different stocks and currencies and grains and metals, energy, other cotton, coffee, cocoa, sugar, and interest rates all around the world, then we may have more of a shot at having kind of a reasonable looking equity curve that doesn't have too many ups and downs. We're sort of hostage to not only trading things that are not stocks, but needing to trade lots of different instruments to cushion and shock absorb a strategy that has these negative characteristics of 60% losing trades and once in a blue moon a really good performance period.
Well, in terms of diversification too, and how it applies to individual investors, I've heard some talk about trend following as an asset class unto itself. That we talk about owning stocks and bonds for the long term, even if we are passive investors, and maybe throwing in some real assets in there too. But do you think of trend following as a separate asset class in that way?
Not really. I'm an extremist, on this subject, diehard. So beware of, listening to my opinions. But no, I see it as a systematic rules. The S&P 500 has its rules, and they're applied. And stocks that go up kind of start taking on kind of bigger influence in the index, and stocks that go down get smaller as a part of the index. So it's a little trend there maybe, but now I see the trend piece as something that can be applied and should be and needs to be applied to all the assets in a portfolio. One of the things that many people have seen about trend following is that it rehabilitates an asset and allows it to be put into the portfolio and be profitable even when on a buy and hold basis, it would not be very profitable. So I'm not sure if cotton or the Swiss franc or the soybeans would be good additions to the portfolio, i.e. make money and offer diversification. But if I trend follow them, they magically do. So I'm kind of don't look forward to reading articles over and over again about, well, what happens, how's gold, should I include gold or real estate in my portfolio? And of course, they'll run the research and the back test and it doesn't look that great. But I'm like, well, I can put that in your portfolio as long as I trend follow it, and it becomes magically a great addition to the portfolio. So I think, with stocks, if I could trend follow the stocks of a portfolio, the return would be about the same and the max drawdown and risk would be materially less.
Yeah, this is a great point, and it's something that I discovered trend following a few years ago, and just trend analysis, and it kind of adding that to my value-based discipline has been a huge benefit to me. It's one of the reasons why I wanted to talk to you, because I teach a value investing course here in town through the community college, and I also teach a part of that just a basic trend following approach, because a lot of people take the class and say, hey, I don't want to do all this analysis. I say, okay, well, if you don't want to do all this analysis, but you want to own stocks, make sure you don't own things that are in a downtrend. And as long as they're in an uptrend, you might not even need to do all the analysis that I'm teaching you to do. So I think that's something, and when you were talking about individual stocks and applying trend following, there's so many obvious cases where you could look at almost any popular stock and just apply a simple trend following approach, whether it's, when the price is above the 200-day or 50 is above the 200-day, you own it and avoid it otherwise. It just makes such, perfect sense. The thing when I show people this, they go, it can't be that easy. It can't be that simple.
I think applying a trend. I was talking to someone the other day, and I was thinking, I think that's a good idea. Use your value approach. Try if you can. I'm not an expert, but it might help to put in a max loss. Take a small loss. Have a stop out point where you just you're interested in keeping your capital, and you may have to buy it again, and that's fine. And maybe time that entry to not trying to buy the very low, but it makes the 50-day high or the 100-day high, or the 50 goes over the 200. Yeah, you've got your analysis done. It's a value stock, but do you have to buy the low? Because you probably bought it 5 or 10 times before then, and it keeps going down. So obviously, no, nothing like that. It's going to be perfect for timing. So I think combining some of these ideas is pretty interesting and probably a good idea. Now, I think putting together a portfolio of different markets or lots of stocks and determining how you're going to do the money management and the kind of risk parity sizing, it can get sort of complicated to where you could sit back and say, wow, the easiest part of this is my entry exit. That's like a third of what I have to get right. And I'm like, yeah, that's right. The entry exit, one of the good things about my experience has been we can look at different entries and exits and a handful or in a certain range of parameters, and they all basically make the same amount of money. So you can't really go wrong, can't really go right. They don't make the same amount of money on a monthly basis. But over a 20-year period, that's nice. It's you would hope that would be the case, but maybe not if you're trying to charge 2 and 20. But it's a complex process to put together the whole portfolio, to choose your leverage and size the positions, and stay out of trouble and not get it mostly right. But I've been on a lot of podcasts, and I have really strong opinions on how to do it right and some of the things that are not right. And then I look at my relative performance, and it seems like I'm highly correlated with everyone else. So I think, I guess some of these things that I can get really excited about don't matter quite as much as trade these markets, go long, go short, and go with the trend, and don't talk yourself out of doing a trade, because the most important thing is not missing a trade. 10% of the trade is going to make all the money. You've got to take those trades, dude, and not let the losses and the drawdowns get to you, because when you hit a big one, that's when you're going to make all your money. And that's when you start to realize that all of my filters and all of my analysis and my intellect, none of it's going to be worth a darn if I didn't hit that trend. If the CTAs don't short crude in 2014 around 90 and hold it to 20, that's a huge mistake. We had sold that crude at 90 a half a dozen times before it finally went. So we just banged our head up against the wall, continuing to do it. And people are like, how'd you know the crude was going to 20? I was like, I had no idea, It was one of many shorts. And I just held on and stuck to my approach, my rules.
And that's such a critical point to make, because, in whatever discipline you use, and in value investing, it's the case a lot of times where, you if you use like a stock screener or something, you'll see, this company looks ugly. Man, that thing's over leveraged and I don't want to own that thing. And then you read a book like Toby Carlisle's Deep Value, and you find out that the best performing value stocks are usually the ugliest. They're in the ugliest business. How do they get so undervalued? Because nobody wants to own them. So when you avoid those things that fit your discipline, you end up a lot of the times missing out on the biggest winners. But you said you're really opinionated about this stuff, and that's one of the reasons why I wanted to talk to you. What do you recommend, or what do you think, for the average investor trying to apply trend following in one respect or another? What do you think is the simplest, most effective way for them to do that?
I would say, obviously, build a diverse portfolio and of stocks, interest rates, commodity ETFs, let's say, maybe gold and silver and crude. And I think that maybe, looking into these ETFs as relates to their liquidity, just stick with the liquid markets and their cost. That's always a concern. But I would say, and this is a radical statement, and I know you can have 100 follow-up questions on this, but not you, but other people. But no, it's just the way I'm saying it. It's going to be kind of a goofy thing to say, and never anyone else advocate this except my friends and people who trade. But choose your portfolio without regard to how the markets have performed in the past. Yeah, strictly diversification. So if you choose a stock, a liquid stock, a real estate, or utility, or a few stocks from each industry, let's say, that's right. Just choose them from each industry, and without regard to how well they performed. It's only how well do they decrease my risk, and I would do that with your commodities and your interest rates, and if you could throw some currencies in there as well, just do what I do, but do it in your IB account or your typical securities account. Probably don't want to venture into crazy futures markets without a lot of experience, but that's what I would say is that people's bottom line need to be, I have this in my portfolio because of the diversification. Because number one is, we've already stipulated, we can't predict what the markets are going to do. It looks like we could, because we all should have known, we've all told ourselves we should have bought Apple and Amazon. But I think that's a trick that our mind plays on us. Now, if they happen to end up in your portfolio, which maybe they would because they're liquid and they're different, great, because your bottom line was diversification, not trying to guess what's going to happen in the future. So that's how I do it, and I've always have done it. And yes, I have a fixed universe of equities that I don't change, and I created that universe to go in with my commodities and currencies and interest rates. that I chose all of those markets just based upon diversification and their liquidity. And I, of course, have to kick a stock out every now and then when if it goes to zero or goes out of business or it gets bought or whatever, or it loses liquidity. But my goal would be to sort of trade the same 50 markets or 100 markets for the rest of my life with this methodology, totally just creating the portfolio based upon diversification.
And in terms of that, I love the idea of like a permanent portfolio. Kind of whether it's an all-weather Ray Dalio type of approach or something else. Meb Faber's actually written a very interesting book on the topic called Global Asset Allocation. But I assume you would recommend a trend following overlay on those individual securities.
Oh, absolutely. Sorry. Yeah, of course.
So, and then in terms of what type of, for the average investor, what type is there a kind of a trade following methodology that you would turn people onto to just introduce them to it?
Well, I like, honestly, I would get my charts out sometimes, and I have in the past, and I have put up breakouts and moving averages on top of these charts, and especially, let's say, a weekly chart. Massive monster trends will sort of pop out if you use a weekly chart and just see what parameter, a moving average or breakout parameters sort of keep you in the trend. And so that's what I would do. I would sit there and say, I think, this has been a 1 or 2 year trend in this particular market. And the parameters I'm looking at now seem to not, they keep me in and I don't keep getting knocked out. And at the very end, it was kind of a painful give back, but, I captured most of the profit. And then I'll give those parameters or those ideas to my research staff, and I'll say, come back to me and tell me what works. And they'll come back, and I won't be too far off just by focusing on the mega trades. There's not that many of them. What parameters did 50 by 200 moving average or 50 by 250, did that keep me in the trend? Yeah, it kind of did. And it was a nice long 2-year, 1-year trend. So, and I didn't give back too much money. So depending upon your capability to actually do the number crunching with Excel or back testing or whatever, you can still get pretty close to the answer, I believe, but it's going to be a long-term approach. That 50 by 200 is pretty darn good.
Okay. And, it's interesting for me I love hearing you say, look at a weekly chart, because I hear from so many people that are long-term investors and they're looking at daily and hourly charts. I'm like, what are you doing? Right? If you're in a short-term day trader, that's your time frame, but match your time frame to the time frame of the charts you're looking at. And then in terms of 50 and 200, you're talking about the 50-day moving average versus the 200-day moving average, right?
That's right.
Okay. You mentioned a few of these lessons that you've learned, obviously, since you left the tutelage of Richard Dennis. What was it that made you leave and start your own firm?
Oh, it was just the end of the program. We had so much fun there with those guys and being successful and learning from them and being their friend, let's say, hopefully, and then being their employee. I was the intellectual growth, and it was phenomenal. I mean, that can never be explained, to the degree that we had it so good, and we never would have left, and none of us would have left. We loved the way we were treated. These are the nicest people in the world as well. Amazing humans. Love Chicago and great friends. And so managing a couple million, we didn't know any better. We didn't know that there was a big world out there, and we were going to get out there and start managing hundreds of millions of dollars and charging 2 and 20 used to. So we had no clue. But we would have actually stayed if they hadn't sort of gotten tired of, all the hassle. And it was a nice run of 4 years, and we probably averaged 150% a year. And then it sort of ended, and we had track records. We kind of knew to go out there and tone it down, and trying to make 150% a year was not going to work for to having investors, and 50% drawdowns were not a good idea. So it took us a while, but we had to get out on our own, and we had a good track record, which we could show people. And people are greedy. They thought that, oh, God, you guys are printing money. They'll throw money at you. And managed futures business, the managed futures industry was sort of starting. We got pretty fortunate at that point.
And, we talked a little bit about, the Wall Street Journal just ran an article about the difficulties of trend following strategies in the past couple of years. I think you hinted a little bit at it that, commodities just haven't been trending. There's some asset classes that haven't been trending like stocks. Is that really what you attribute the underperformance to lately?
As it relates to CTAs and managed futures, I think CTAs, I don't want to be too picky or defensive, but I think CTAs and managed futures, that's a different category. That's a different subject versus trend following. And like I said earlier, trend following is working great if you're only doing it in the stocks, i.e., the only markets that are really trending, and they're trending higher, which is, the long trades are better. So if you're a CTA, though, and you use trend following, and you're trying to do what you've done for many years and offer diversification in currencies, commodities, and interest rates, plus part of your portfolio would probably be equities as well, then that has not done well because there hasn't been the big trends. It's hard to even know if trend following is that great or if it's having troubles or if there's too many people doing it because the markets have been so bad. But not if you're only trading equities, though. The trend following has been fantastic. So, what has kept people in the market, given all the negative press and high valuations, if not just closing your eyes and just following the trend and closing your ears maybe and just following the trend and don't listen to anything else, none of the logic that I'm sure is correct about the overvaluation of the market and how it's got to end one of these days. But so I do think that CTAs have taken it on the chin, but too bad we didn't all see that we should have a stock-only program or mostly a stock program from a marketing point of view, AUM raising point of view. That would have been way more appealing to the majority of clients who, some of them may not have a problem with trend following, but are sort of maybe skeptical of short commodities and all the crazy markets we try to add in there. I think we're just hard-headed. Managed futures was hard-headed, and instead of taking these wonderful approach that we had with risk control, taking small losses and paying attention to price only, and doing shorts when the trend justified doing some shorts, we tried to just cram down investors' throats what we thought they should want. And if they didn't buy it, well, they just don't understand, or we're not doing a good job of explaining it. But the fact of the matter is, stocks are great. People prefer stocks, and they've done fantastic.
Well, and haven't commodities been, very good for trend following in years past, right?
Oh yeah, prior to 2008, a massive, strong up moves in metals and energy, of course, many times, natural gas, many times. My first big trade, having left Richard Dennis in the spring of '88, was pretty much the last Midwest drought, soybeans and corn and wheat. So yeah, 100% coffee, amazing. Sugar shorts. Yeah, so yeah, commodities, it's just been recently, and earlier this year, all the commodity markets kind of petered out, except for energy. Energy's hanging in there. But we had been long base metals, soybeans, and energy and cocoa, cotton. So a lot of these trades have kind of petered out recently with the trade war, tariffs, or whatever.
Yeah, it's just interesting to me that I guess you would talk about doing an equity-only strategy when, for a long time, commodities have seemingly been, trend following has been a wonderful way to play the commodity markets. How Have you thought about putting together an equity only fund?
Well, I think that technically, I think that could be not something I would think would be as safe, or the drawdowns could be relatively high. But I do think 50% stocks, 2/3 stocks, and let's sprinkle in these wonderful commodities and currencies and interest rates. That could probably be a very viable project where you're increasing your correlation to equities when they're so good, and not putting so much pressure on people to hold on to an underperforming asset class where stocks are a smaller percentage, but you're still getting some good diversification when the inevitable, February 2018 happens or 2008 happens. You're still getting a little bit of diversification, just not as much as you're getting now. But this is as soon as I come out with this fund, it'll be that'll be a good signal for.
You're right. Well, I was going to ask you, would it be long only or long short?
Oh gosh,
I mean, a long short equity only trend following fund sounds pretty interesting. I mean, who is it? I'm spacing on his name, but famous value investor who created a long short, and it's purely quantitative, mutual fund, and that seems like if you did it instead of a quantitative, based on fundamentals, you do quantitative trend following approach that's long short equity only, would be pretty interesting.
I agree. Yeah, it's just a question of finding some shorts sometimes. I think now there's a lot of shorts out there. I did a scan of the 100 most liquid markets, stocks out there, and I went through the charts, and I think 40 of them were in uptrends. So this was of a few weeks ago. Maybe it's changed, but I don't think that the market is as crazy long as I'd say something like 2013. I know in 2013, of the stocks that we traded, we had a super year. We made 20%, and over 100% of that came from equities. And I bet you we were invested in over 95% of the stocks that we trade. And now we're probably invested in half or a third. So it's some markets, the big stocks are moving, but it doesn't seem out of control now.
Yeah. Well, it's definitely a different breadth environment than it was back then, or even it was at the end of last year. I'm going to totally change gears here for a second. You have kids, right?
I do.
And I think I read somewhere you homeschool your kids. Is that true?
We did back in the day. Okay. Those kids are now in 29, 31, 32.
Okay. Mine are just on the verge of heading out on their own, and we did homeschool for a few years. But it's also interesting to me because I just interviewed Ben Hunt on the podcast. He's a brilliant guy like yourself, and he homeschools also. And I'm thinking, what is it with all these guys homeschooling? What was it for you guys that really appealed to you about it?
Well, I think it was something to do, and we had a good community who was encouraging in that regard. I think so. Our kids spent 8 years and in homeschool, and I think they enjoyed it. And I think then in ninth grade they did go to regular high school, a local prep school in Virginia, Richmond, Virginia, and so they. I think one of the lessons was that it was sort of difficult without the rigorous competition, and just sort of doing it with your mom and dad. I think my daughter probably had a boyfriend after 1 or 2 weeks in regular school, but getting kind of used to a high level competitive environment that's exists in some of these prep schools and different public schools around the country. It was something she wasn't used to. So the social aspect, people are always wondering, well, how about the social aspect? I think some kids can adapt to that a lot quicker than they can get used to. When mom and dad grades a paper, not quite the same as a teacher.
Yeah. Well, there's something, it's definitely a contrarian decision to, homeschool your kids. And you said you had a welcoming environment, community in which to do that. And it's not always the case. It also seems to me that it promotes independent thinking, right? It's kind of where it comes from. Do you think there's anything, in terms of that decision to homeschool or anything that applies to your investment, views or anything like that?
I think to some degree, I like what you just said. And I think that sometimes if the child is very talented and very open-minded and not going to be too dependent on, be devastated by the opinion of their peers, then that would be a good thing for them to be able to explore the world. And they got a great parent, let's say, who's really smart and really maybe was similar. And so, I think getting out there and exploring the world in an unconventional way could really be fun. And you would actually get an education that was as good or better and different. And I think similarly in trading, at least the way we do it, which I have mention as many of the aspects of it as I possibly could today, so you're not missing anything when I say this, and that is that you really need to be independent. You really must be someone who doesn't crave positive feedback. You're happy if everyone disagrees with your positions. In fact, you're a little nervous if they don't. You need to have that sort of mentality. You need to be afraid or a little disappointed if everyone is extolling the virtues of trend following. I mean, I don't really like the fact that that we're in drawdowns frequently, or we're not doing as well as the stock market. But the answer to the question, the true-false question I mentioned earlier in the show, is true. A trader should love their losses. It's part of the process, and I love my process. I love my systems. I love my rules. I think everything about them is wonderful. Hell, I put them together. It's 35 years worth of thinking and understanding and researching and testing. And whatever characteristics they may have, it's like with a child, you love them. You love those characteristics. If one of the characteristics is frequent drawdowns, embrace it. It just means that you're doing the right thing, you're following the rules, you're not overriding your process to prevent those losses from coming. You've got to have the good with the bad with the good. So, I think just having sort of a contrary opinion through and through and being strong, I think, that a child like that would probably do well with homeschool and with trading.
Oh man, I love that. I think everybody needs to rewind and listen to that section over again. Jerry, we're just about out of time. For people who want to keep up with you and your ideas, where can they get in touch with that kind of stuff?
Most of my crazy ideas, I'm feverishly tweeting them on Twitter at RJ Parker Jr. 09. And then for the Chesapeake stuff, ChesapeakeCapital.com, and podcast. I'm doing more podcasts than ever before.
Well, I appreciate you doing this podcast. This has been a blast. I'm really grateful to you for sharing all your wisdom with us, and I'd love to have you on again sometime in the near future.
Well, thank you. You're a perfect host. I enjoyed it, and I really appreciate it.
Looking good, Billy Ray!
Feeling good, Louis! And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and charts related to this episode at thefelderreport.com. Thank you so much for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.